Right now, Nuburu Inc. is trading at $0.51 per share, reflecting an intraday climb of 0.037, which translates to a 7.74% gain on the day. Seeing a spike like that on a stock with a sub-$1 price point immediately triggers a specific kind of investor interest. The expectation is that you've stumbled upon a hidden gem, a piece of high technology on the verge of a breakout, available at a bargain bin price. But that initial surge of optimism is based on a dangerously incomplete picture. The reality of Nuburu's situation is not a story of imminent technological triumph, but one of a desperate and brutal fight for corporate survival, where today's gain is less a sign of strength and more a flicker of volatility in a stock facing existential threats. The real narrative here has very little to do with the promise of its blue laser technology and everything to do with the cold, hard mechanics of stock market listing requirements and severe financial distress. Many traders, perhaps using a platform like the Robinhood app to scan for daily movers, will see this and think they've found an opportunity. The company operates in a field that sounds undeniably futuristic: high-power industrial blue lasers. The applications are compelling, particularly in welding copper and other reflective metals, a critical process for manufacturing electric vehicle batteries, consumer electronics, and components for the aerospace industry. The general belief is that if you can get into a company with such seemingly essential technology this early and this cheap, the potential upside is enormous. It feels like buying into the next big thing before the rest of the market catches on. Some might even consider it a speculative addition to a portfolio managed through services like Schwab Intelligent Portfolios, though that would be a highly aggressive allocation. This line of thinking, however, glosses over the fundamental sickness within the company's financial structure and its precarious position on the public market. Challenging this common perception is crucial because treating Nuburu stock as a simple growth play is a significant miscalculation. The recent stock movement is not being driven by a new landmark contract or a technological breakthrough. It's being driven by the aftershocks of a 1-for-40 reverse stock split executed just a few months ago, a move designed not to create shareholder value, but to artificially inflate the stock price to avoid being delisted from the NYSE American exchange. This is a classic sign of a company in deep trouble, and any analysis that ignores this is setting investors up for failure. Let's dissect the recent trading activity more closely. A 7% or 8% gain seems impressive, but when the absolute price is around 50 cents, such volatility is commonplace and often meaningless. It can be triggered by a very small volume of retail buying, amplified by algorithmic trading. The average daily volume for Nuburu is often erratic, and days with significant price swings aren't always accompanied by the kind of heavy institutional volume you'd want to see to confirm a real shift in sentiment. Instead, what we're likely witnessing is speculative churn from day traders. These are not long-term believers building a position in their Fidelity brokerage account. These are traders looking to scalp a few cents of profit from the noise. The 1-for-40 reverse split is the elephant in the room. In August 2024, the company consolidated every 40 shares held by investors into a single share. This maneuver took the stock price from the pennies to over $1, temporarily satisfying the exchange's minimum bid price requirement. However, reverse splits are overwhelmingly viewed as a bearish indicator by seasoned market participants. They do nothing to change the underlying value of the company. They simply reduce the number of shares outstanding. Historically, the vast majority of companies that resort to this measure see their stock price continue to decline afterward, as the market recognizes that the fundamental problems, poor performance, cash burn, lack of profitability, have not been addressed. The fact that BRU is already back down to the 0.50 range post-split validates this concern entirely. Furthermore, we have to look at the company's recent filings with the Securities and Exchange Commission. Nuburu has been consistently signaling its need for capital. This often means a forthcoming share offering, which would be highly dilutive to current shareholders. When a company sells more shares into the market, it increases the total share count, meaning each existing share represents a smaller percentage of ownership in the company. For a company like Nuburu, whose financial position is already so fragile, another round of equity financing at these depressed price levels would be incredibly damaging to investor value. These are the kinds of details that a sophisticated trading platform like Interactive Brokers allows you to dig into, looking past the simple price chart and into the regulatory filings that tell the real story. The macroeconomic environment only makes matters worse. We are in a period of higher interest rates, which makes it more difficult and expensive for companies, especially unprofitable ones, to borrow money or raise capital. The easy access to funding that characterized the last decade is gone. For a company that is burning through its cash reserves at a significant rate, this backdrop is a formidable headwind. Potential customers in the industrial sector may also be pulling back on capital expenditures amid economic uncertainty, which directly impacts Nuburu's sales pipeline. So while the company's technology is designed for growth industries like EVs, its own financial instability prevents it from fully capitalizing on that potential. It's a painful paradox where the promise of the technology is held captive by the weakness of the balance sheet. This isn't a stock you'd likely find in mainstream Fidelity ETFs or Fidelity mutual funds. Its risk profile is simply too high for that kind of broad-based investment. So, what exactly does Nuburu do? The company's core innovation is its ability to combine the output of multiple blue laser diodes into a single, powerful, and very bright beam. The key scientific principle here is that the 450 nanometer wavelength of blue light is absorbed much more effectively by materials like copper and gold than the infrared lasers that have traditionally dominated the industrial welding and cutting market. When an infrared laser hits copper, much of its energy is reflected away, making the welding process inefficient and prone to defects. Nuburu's blue laser, in contrast, gets absorbed readily, allowing for faster, cleaner, and stronger welds with minimal spatter. This is a genuine technological advantage, particularly for welding the thin copper foils used in EV battery bus bars and connectors. A better weld means better electrical conductivity and a more reliable battery pack. The business model is to sell these laser systems and light engines to industrial integrators and end users in manufacturing. Their past performance, however, tells a story of struggle. Revenue has been inconsistent, and more importantly, the company is nowhere near profitability. A look at their income statement reveals significant and persistent net losses quarter after quarter. Their balance sheet shows a dwindling cash position, which is the lifeblood of any pre-profitability tech company. This high rate of cash burn is precisely why the threat of dilutive financing is so constant. The expectation of a superior technology translating into a superior business has not matched the reality of their financial results. The company went public via a SPAC, a special purpose acquisition company merger, a route that has produced a notoriously poor track record of performance for retail investors. Many companies that took this path were not ready for the scrutiny and financial discipline required of a public entity, and Nuburu appears to be another casualty of that trend. Looking forward, the future outlook for Nuburu stock is a study in binary outcomes. The bull case, the one that keeps speculators interested, hinges on the company securing a lifeline. This could come in the form of a major company-making contract from a large automotive or electronics manufacturer. Another possibility is a strategic partnership or even an acquisition by a larger industrial technology firm that wants to integrate blue laser capabilities into its portfolio. In this scenario, investors using a platform like SoFi Invest for SoFi Active Investing might see a sudden dramatic return. This is the narrow path to success, and it requires flawless execution and a significant amount of luck. It's the kind of high-risk, high-reward bet that some people make through self-investing on investing sites, hoping to catch a falling knife at just the right moment. The bear case, unfortunately, is far more probable and grounded in the company's current reality. The most immediate risk is continued cash burn, forcing the company into a series of increasingly desperate and dilutive capital raises, which would crush the stock price further. There's also competitive risk. While Nuburu has a strong position in blue laser technology, they are not the only players, and larger, better capitalized competitors could eventually close the technology gap. And the delisting threat has not disappeared. While the reverse split bought them time, a continued slide in the share price could put them right back in non-compliance with the NYSE American's rules. If they are delisted and forced to trade on the over-the-counter OTC markets, liquidity would dry up and most institutional investors would be forced to sell, causing the stock to collapse. This is a very real possibility. When considering such a speculative asset, it's vital to use robust tools. Many investors turn to the Fidelity mobile app or Robinhood stock trading for accessibility, but for a deep analysis, the platform